Hello and welcome to the Alhambra Investments Global Asset Allocation Update for September 2018. I'm Bob Williams. I will tell you right up front that our risk budget this month has not changed. For our moderate investors, we are still 50% in risk assets, 50% in bonds. And I'm going to bring Joe Calhoun in to talk a little bit. At the end of this, we'll show you our portfolio, the breakdown by category. But Joe, you told me a few days ago this has been a tough one for you. There's a lot of things going on. You had a hard time making a decision about whether to move or whether to stay. Tell me what was going on.
Well, I think that there's a lot of distortions in the market right now because of what's going on with the trade negotiations in particular. And I generally come back to when I'm not sure what to do. Something I was told a long time ago when I first got in this business. A guy told me, he said, if you come in every day and you ask yourself, what should you do to your portfolio today? The answer should be most days should be nothing. And I think a lot of times we try to do too much and try to trade too much. I wanted to avoid that, but it was a very difficult decision this month. I mean, look, the portfolios have struggled a little bit this year. We'll talk about why that's true, but I mean, it's not just true of us. It's true of anyone running a diversified portfolio. Essentially, the only thing that's worked is U.S. stocks, and that's it's a piece of our portfolio, but it's only a piece. And so it's been a difficult time, I think, this year trying to figure out, should we do more in U.S. stocks? Should we not do more? Should we continue to use the strategy that we're using? And my answer on that was yes. We're going to continue to use this strategy. It's the right one for us the long term. It does what we want it to do, and the fact that it has a tough period. 6 months, a year, 2 years, whatever the case may be, even 3 years. That doesn't mean it's not a legitimate strategy. It just means that no strategy works all the time. And I do think this is the best one for us and our clients. It's the one I feel most comfortable with, and it's what we'll keep using.
And isn't that really the case? Investing is a process, and you stick to your process for the long run.
Well, what I always tell people is, look, if you have a strategy and you change that strategy every few years, you don't really have a strategy. What you have is you're just chasing returns. We know that nothing works all the time, and you have to have a process, which we do, and you have to stick to it. And a strategy is the overall guiding force of your portfolio. Tactics are more short-term things. And really what we look at mostly in these monthly updates is the tactical part of the portfolio. That was also difficult this month. I mean, even though it's fairly short-term stuff, tactical changes are difficult because you're trying to decide if a trend is emerging and is going to be sustainable, or whether it's a short-term move that's about to reverse. And of course, we don't have the benefit of 20/20 hindsight, so we have to try to figure this stuff out in advance. And as I've told you many times, my crystal ball's got a crack. So we try to do the best we can, but there's no guarantees on this stuff.
You mentioned a minute ago that U.S. stocks have done pretty well this year. And if you look at the Dow, fairly decent gains, S&P, fairly decent gains. But those gains have been concentrated in very narrow regions, even within U.S. stocks. So what do you see in that?
Well, look, one of the things that everybody needs to know if they're working with us is I'm a value guy. That's just the way I am. And by the way, I don't think that's something that you change. I think you're either born a value investor or you're born a momentum, growth type investor. I think you're one or the other. I was born a value investor. I am a cheap guy. I want to buy cheap stuff. And that's always worked in my career. I've been doing this over 25 years now. And really, my theory of investing, or if you want to call it that, from the very beginning of my career was buy cheap stuff, wait for it to go up, and then get rid of it and go find more cheap stuff. It's not complicated. We're not talking rocket science here. I just want to buy cheap things. And we buy cheap things because it gives us what they talk about at Warren Buffett's mentor, Ben Graham, what he talked about was a margin of safety. Well, you buy cheap things, you have a margin of safety. Yeah, they can get cheaper, but they can only get so cheap unless they go out of business. And generally, we're buying indexes or markets, which are not going to go out of business. With a growth investor, if you're paying 30, 40, 50 times earnings for something and something goes wrong, suddenly, overnight you can lose half your money. Generally, we don't see that in value investing. So point is that this year, and really most of the last decade, growth and momentum has been the place to be. Well, it's a difficult thing if you're a value investor because we didn't get that growth and momentum. So being a value investor these days is a tough gig, but I am convinced that value investing is not something that is a flash in the pan. It's been working for a very, very long time. And we know, by the way, that value has outperformed growth over the long term. So the fact that it's underperformed this year or underperformed over the last 5 years or 10 years really is kind of irrelevant. All that means to me is that when the snapback comes, it's going to be that much bigger.
I will never call you cheap. I will call you thrifty, though.
Well, my wife has a different term for it, but we won't go there. Uh, she falls more into the cheap category. She calls me more cheap than anything else. But, however you want to put it, cheap, thrifty, whatever. That's me.
Isn't one of the hazards of investing that people want to look January 1 to January 1 instead of looking trough to trough or peak to peak?
Well, yeah, it is. I mean, looking at performance over a 9-month period is kind of a waste of time. I mean, we're in September here. What's happened from January to September in the big scheme of things is kind of irrelevant. One of the things we know about investing, especially in the stock market, is that the returns are what we call lumpy. It's not like buying a CD or something where you're going to get an interest payment every quarter or every month or whatever the case may be. You're going to get paid, and you're going to get paid in lumps, and then you're going to go long periods where you don't make anything. You may go periods where you lose money, and then you make a bunch. And it's just the way the beast works. And so, yeah, I mean, looking at 9 months or a year, and sometimes I would say even 3 or 4 years is really not relevant. You got to think full cycle. An economic cycle, if you measure from peak to trough, you're going to get one result. And if you measure from trough to peak, you get a different result. You need to go peak to peak or trough to trough, one or the other. But you need to be comparing apples and apples.
Well, I've seen a lot of headlines in the last few days, and this has been going on since 1987 when you and I were kind of new in the business. And all the headlines say, "Are you ready for September?" Because you know what could happen in September.
I will. Let me just say this: I see these things all the time. One of my favorite, actually, we used to get it in paper. Now it's on the web, of course. But Stock Traders Almanac, Jeffrey Hirsch and his dad run that thing forever. I don't know how long, and they always have these little seasonal things. Buy in October and sell in May and go away, and all these other little things. Look, one of the things everybody needs to understand. Yes. September is it's actually the worst month of the year if you measure them each month and look at the returns. A lot of people think it's October because we've had a number of crashes in October. The crash of 87 was in October, 29 was in October. The worst month statistically is September. And you know what that means? Yeah, not much. Look, we statistically you don't have enough Septembers with data to really draw any conclusions. It doesn't mean a thing. There has always been this thing in the market, in the U.S. stock market, about that the fall is a tough time. And it used to be back in the old days, people used to think, well, it's because that's harvest time. And what happens is that there's something to do with the farmers moving money into the city or out of the city or something. I don't know. Somebody always had an excuse for it. It had something to do with farmers. I don't think that's going on these days. I'm not sure that's it. So whatever that explanation was back in the day, I don't think that would apply us today. I don't think it applied then, but look, I don't pay attention to these things. How something goes. It's kind of like baseball. You got a statistic for everything, he's hitting 472 with a man on first and 2 outs, and this guy eating a hot dog up here. You can always come up with something.
You use the word decoupling in this report, and really decoupling from foreign markets. Fill that in for me.
Well, I think there's this idea going around here that I want to be careful how I say this. We don't like to talk politics around here. So let's just say that there are trade negotiations going on. And there is a perception, I believe, in the market that the rest of the world is going to lose and the United States is going to win because of the way these things are going to work out, that we're going to come out better than everybody else. In other words, when you look at markets these days, that shows up in a number of different ways. It shows up in a higher dollar this year. although, as I say in the report, the dollar actually hasn't acted all that great. I'm kind of surprised that we're getting as much press as we are about the dollar. It really hasn't performed that well, except against some really, really lousy currencies. I mean, the fact that the dollar's up a whole bunch against the Turkish lira and the Argentine peso, I don't think is all that shocking. And we're not, the euro had to move from 103 to 125. We're back to 116. That's just pretty normal stuff. And the yen is actually up. So, when we look at the dollar, I think people are looking at it and drawing conclusions about that maybe are not completely true. So it's decoupling idea. So the idea that the United States is going to win these trade battles and we're going to come out way ahead and everybody else is going to come out on the losing end. It's the only conclusion I can draw from the way the markets are acting. Because when you look at stock markets around the world, you only find a couple that are up. The United States is up, obviously. S&P's up right around 9% this year. Although, as we said earlier, big difference between growth and value. Value's up 3, growth's up 18. So big difference in divergence in performance there. And that growth piece, by the way, is mostly momentum. We're talking about the Amazons of the world, the Netflixes of the world, and so forth. Anyway, when you look around the world, the only other major economy, a major market, and it's not even all that major that I can find that's up, is Taiwan. We're not talking, a significant, huge economy here. I guess it's probably in the top 10 in the world, but it's not anywhere close to the top. But you look at countries like, South Korea is down 18%, China's down, Europe's down, Brazil is down, India's down, everybody's down. So this idea that we're going to win and everybody else loses, I just don't buy that. It's not the way the world works.
Has there been any capital flight since these foreign countries are looking like they're not in great shape, and so we've got a lot of cash coming back into the U.S.?
Well, I think there is some truth to that. I mean, you have to look at the dollar and say, well, the dollar is up some this year. There's obviously been a little bit more demand for it than there has been supply. So in that sense, yes, there has been some capital, I guess, coming back to the United States. I think, though, that there's a couple of fallacies there. This one about, companies are bringing money back home. With the tax reform, they're bringing capital back to the United States, and that's helping the dollar. Well, no, not really. That money was parked in dollars a long time ago. U.S. companies, Apple, did not keep their money over in Ireland and park it in UK, in pounds, and they didn't put it in euros. What did they do? They bought U.S. corporate bonds. That's what they did. So the fact is that money has been sitting in U.S. dollars for a long time. So the fact that it's coming home doesn't really have an impact on the dollar. It does have an impact, or may have an impact, on the corporate bond market, by the way. But if anything, that effect is going to be negative because it's going to raise rates because these companies are bringing this money back home. They're buying back stock. They're doing whatever they're doing with it, which, by the way, I mean, the idea was they would bring it home and invest in plant and equipment, actual honest-to-God investments in the economy. That doesn't seem to be happening. But they are buying back stock, so now there's a less of a demand for corporate bonds in some sense. But that would be a negative for corporate America, not a positive. No, go ahead.
No, I was just going to say, most of that stuff just boggles the mind of the balanced investor. I mean, sitting there pulling their hair out because, it's not like anything they've seen for a while, or at least for a long, long time.
Well, like I said, when in the report, if you take a look at what's going on, if you're running a diversified portfolio right now, unless it's diversified in the sense that you have only U.S. stocks and only U.S. bonds. Now, if that's your diversified portfolio, you've done okay, assuming that you own the S&P 500 or something growthy. If you own the S&P Value Index, you're up 3% on your stock side, and if you own the aggregate bond index, you're down over 1%. So what's your net return this year? A couple of percent? Now, if you own the S&P 500 and you own the aggregate bond, maybe you're up 6 or 7% this year. If you own S&P 500 growth, you're probably up close to double digits. But, when I say diversified portfolio, I'm thinking diversification across asset classes. So give me some stocks, U.S. stocks and foreign stocks. Give me some real estate, maybe in the form of some REITs. Give me some commodities in the form of gold or something else. Doesn't have to be a big piece, but you need that stuff in there. And then give me a big chunk of bonds. Well, my bonds are down. My commodities are down. My REITs are up a little bit, about like the value index. Foreign stocks are all down. So the only thing I've really got that's up significantly is the S&P 500. Or excuse me, I take that back. We do own the Russell 2000. We own some small cap stocks. That's done pretty well too. So yeah, I mean, if you're trying to diversify and do things by the book, so to speak. The book says the more you diversify, you lower your risk and you get a higher risk-adjusted return. Yeah, that's not working. If you're a diversified investor, what you're getting is just lower returns. So does that mean that Harry Markowitz and all that research he did on modern portfolio theory it's just bunk? Does that mean that, I don't know, the Bible, where it tells you that you ought not put all your eggs in one basket, that it's just not working anymore? I got to think that diversification does work, and it will work again. And the fact that it doesn't work for the first 9 months of this year doesn't really say all that much.
In this report, you also talked about the fortress theory. And so in looking at that, is tax cuts and tariffs and deregulation really kind of an economic trinity that's driving things at the moment?
Well, I think that the idea is that there's this fortress America, that we don't need the rest of the world, that we can do all this stuff on our own. We've got all these things driving the U.S. economy that are going to continue to do so. I think probably the piece that's gotten the least attention there is the deregulation piece. And I think that probably has had a bigger impact. I think a lot of people concentrate on the tax cuts, and I think the tax cuts have had some of an impact, but I don't think it's really what everybody expected as far as how that money was going to be deployed. We haven't seen some big ramp up in capital spending, which is what we really need to see a rise in productivity somewhere down the road. We're just not seeing it. That we have seen a little bit of a ramp up in capital spending. It's not a big number, not a big change. And the idea that we don't need the rest of the world, that we're all fine by ourselves, just isn't true. We need the rest of the world, and the rest of the world needs us. And I've seen a thing with this Bob Woodward book out about Donald Trump and about President Trump, and in one case he writes in the margin of a speech that he's giving, trade is bad. I got to tell you, man, that's just about as wrong as you can get. I think for a lot of reasons, trade is really good. It's not just economic either. There's an old saying that if either goods will cross borders or armies will. You need goodwill across the world, and you're going to get that through trade. If you don't get it through trade, you're going to have problems. And that really worries me a lot, actually.
You talked in the report about perception versus reality. How do you justify those two where we are right now?
Well, that's that perception, right? The perception is that the United States is doing great. U.S. stock market is going up, and it's going up for good reason. Well, that's fine, but let's talk about another market. I can show you a market that trades at 12 times earnings versus, and this is forward earnings estimates, but even if you use trailing earnings, we're talking lower numbers. But say on forward earnings, since everybody wants to use that right now because it makes it easier for them to justify buying U.S. stocks, so let's look at this other market. This other market is 12 times earnings versus the U.S., which is 18 or 19 times. 1.3 times book value versus about 5 times book value in the United States. Earnings growth last year in this country, in this market, was over 30%. It's pretty good here too, up in the 20s, but not as much as this company or as this country. I could go on and on. Profit margins in the United States, net margins, you're talking net profits after tax, peaked in the United States in 2012 at about 12%. We're now down around 9 or 10. This other country had been stuck down around 3 or 4, and then now it's up to almost 8, and it's on the rise. Now, here's the thing. That market that we're talking about is down this year. Even after all that market's down. The U.S. is up. What's the other market? It's Japan. Japan's corporate performance has been phenomenal the last few years, and we did make good money in Japan. But this year, perception is that Japan is no different than it's been for the last 25 or 30 years. It's still a basket case. It still has deflation. It still has all these problems. And apparently, all these people that write these commentaries about how bad Japan is, they've never been there, or they haven't bothered to actually look at the economic statistics or look at the corporate performance and see that things really have changed. We will continue to operate in a way where we're thinking about what we're doing and not just acting mindlessly to the momentum.
We have a process, and we will stick to it. We are going to put up on the screen right now the breakdown of our portfolio so everybody can see the categories and the percentages. There's a lot more in Joe's report. Here's where you can read the entire report, and we'll be back to give you the asset allocation update in October. Thanks, Joe.
Thanks.